us a perspective, and those are his top picks. We'll let you go, Rajesh. We'll let you go as well. Kunal, thank you so much for joining us. Let me go across. We have Samir Arora, Helios Capital, joining us this morning. Samir, great having you. Samir, still continuing to be overweight financial services, I see, 33%. You're a big bull with regard to the platform companies. So you're at both ends where the index is concerned, the biggest heavyweight and the newest entrant.
Actually, I don't know about this 33% because maybe you're talking about the flexi cap, but in general, across my funds, yes, we are overweight in financials. And actually, we've always felt that we don't have any fixed formula. So you can buy on one end the cheap, the undervalued, the beaten up. And on the other hand, you can buy a few very high growth stocks which would not fit a standard framework of I buy value or I buy growth. Every stock has to be justified on its own merit and fits, if broadly, if you want it to fit in a portfolio to cover all angles.
Samir, morning, Sajid here. How do you look at financials now? You've seen the first quarter numbers coming in, decent set coming from the PSU pack. There's some margin pressure which some of the private sector banks have seen. What is your take between a way to play within the financial services?
So as of now, we like NBFCs more than our banks. We own the banks, and we are very unhappy with our big holding, which you know which one it is because we have had too much patience. But anyway, so overall, we have the banks, the private banks, and also State Bank of India, which is doing well and has good results. And on the other hand, we are more excited in terms of new buying NBFCs and other things rather than the banks.
Samir, are you saying that you're running out of patience with respect to HDFC Bank?
I am running out of patience in the sense that, it's a bit too much to every day see that it is falling or not going up in good market, bad market. It is there, but broadly we are saying, at least for me, forget about the Indian mutual fund because they have other benchmarks and other issues. I will not buy till it does well on its own as a stock first for some time. I have what I have.
Point taken, Samir, but give us the rationale. So what should
my rationale is that sometimes the market knows more than me. I don't know. Maybe it's been disrupted. I don't care. I have had enough of it. So I am not selling in my domestic funds. I mean, India funds and all that. I am not going to buy till it goes up on its own 10-15%. Then I will say, okay, it's cheap. I am not going to keep buying every day thinking it is cheap, because there is a limit to how much even my patience is. And I am, yes.
But
at
Samir,
the edge of it.
Right. Samir,
and I don't care what are the reasons, what is the issue. I am a practical guy. And a practical guy says that every day you can't have the stock falling and saying everything is okay. But anyway, I have it. It's a cheap stock. It's one of our top stocks. It might be second, third largest for me. And in India, maybe fourth, fifth largest. But please, there has to be a limit. We can't keep saying, very good to everything. Yes, please.
Very candid, Samir.
What you see is what you get. What I feel is what I tell.
No, absolutely. Really appreciate that. That's one of the joys of.
But that is the beauty of having a portfolio where maybe it's 4-5% of our fund. And then there's another 5%, which is something else. And that makes up. So at the end of the day, the reason you can do this for 30 years and more, and I also short stocks. So which means I have, say, 45, 50 long, 20 short. And therefore, every day I worry that my one short has gone up or my long has gone down. I cannot handle it. And not that I feel like that. I'm saying the way to do it is to look at the consolidated portfolio. And since our portfolio is doing well, you get bugged once in a while with some stocks, but you can't overdo your thinking about it and getting, anxious about it, because at the end, it's a portfolio with, in my case, maybe 50 long and 20 short. And overall, they are working sometimes because of new age, sometimes because of Ather, sometimes because of something, some Adani. And sometimes they used to do well because of HDFC Bank, which recently, 2-3 years, they have not because of that.
Right. Samir, I'm just trying to get a sense. You've been here for so long. Do you believe, all the negatives have been priced in? I know that you said that there could still be negatives out there which you're not aware about, but broadly, I mean, this is as bad
I
as it
don't want
gets,
to
right?
talk about it. I
Okay.
am for 30 years. My life is not determined by one stock.
Of
It
course
is
not.
4% of my fund. People have 9 and 10% ask them these questions. You all ask them other questions. My life is not defined by either Eternal or HDFC Bank. So don't ask me on these two stocks because it makes it look that I am a single stock fund manager and I'm not. And that is the way of you see our domestic funds. No one stock has defined our life. So I cannot spend every interview, every minute for HDFC Bank on the this side and Eternal on the other. Please ask me
Samir,
anything else.
where do you see the market from a portfolio point of view going? You've seen the earnings, first quarter earnings come in. It's much better than expected, but we are still, if you compare to the regional markets, the growth has been still is muted as compared to them. 15,
Actually, it's
16.
very good. Actually, these days it is not muted. If you see even the pure performance of India versus say Korea, Taiwan, and all, it has massively outperformed for like month and a half. Particularly July, India was much better, and I think June also. I forget the exact dates, but broadly, India has shown, or maybe Korea and Taiwan have shown to the regional managers that you cannot overdo your weights in any one market or in some cases one stock because the volatility of those stocks has been so high that somebody might be bullish but he will remember how they suddenly lost X% in a month, and therefore India is actually now okay. Plus Indian earnings have been very good. And if you take out these one or two stocks like Samsung, where the return earnings growth might have been 500-600%, but basically you lost 30% in a month. So, people, it's like what I was saying about these banks and all. You don't only look at one thing, you look at how the market is reacting one way or the other and keep saying that it's 4P for say HD, for Samsung has not helped at least in the last 2-3 months. So India has actually done well, and you can see that also in the flows. The flows have stopped being negative. They are not greatly positive, but the first step is to not be negative. Secondly, the currency has broadly been okay, and therefore there is no day-to-day negativity that every morning you come and expect the market to be down, and it is not down. So it's very good compared to what it was, say, 3-4 months ago.
And how do you look at the IPO market? There's more issues which are coming in. Are you looking at some of them? And
Yes.
how do you look at the valuation which they are coming at?
So, if you see the number of IPOs, mostly the mutual fund guys do more IPOs than me. But if you see as a firm, because it's the same philosophy, I'm the founder, my philosophy is being used. You see the number of IPOs we do versus others. So if there were, I don't know, maybe 50 IPOs last year, we would have done as Helios India, maybe 5, 6 IPOs. So that way we are particular, but the ones we like, we want to hustle to get a anchor allocation. But mostly what happens is the anchor allocation is given to funds who blindly buy every IPO because then the investment banks think that on a bad day they can ask those funds to even buy a bad IPO. For us, because we refuse to buy 70, 80 or 90% of the IPOs and are only interested in 10%, we don't even get those 10% easily because the selling side guys think that we are opportunistic. Although after that, we broadly don't sell those stocks in the sense that we are, I think, much less flipping oriented on IPOs than all these guys who buy every IPO that comes. And you can see that from the names. If you want to do research, just write down last 30 IPOs, see which funds bought each and every of those or 85% of those, and see 1 month later whether it came in their portfolios. Mostly those stocks have disappeared after the first buying, I mean, the anchor buying. Our case is different. Therefore, we don't get much. Therefore, overall, it doesn't change our life much because the ones we like, people don't give us enough. Uh, but that is just the way the model is, that we are not going to buy an extra IPO just to win favors with the investment bank.
You see that as a flaw in the current IPO system that bankers favor buy side guys who are there in queue for every IPO.
It is not a flaw. That is reality. Sometimes it may not be because of buying every IPO. I mean, to take even a loss, but maybe because the business that they give is very high. But it's obviously totally discretionary. It's effectively a institutional bribing system, but it's not to an individual, it's to the fund. So that way you can't say it's wrong. But you can see that the guys who buy every IPO, in theory, if they bought 40 IPOs last year, I may not exactly know, but you please count, you'll find at least 25, 30 IPOs. Obviously, at the end of 3 months, these guys were not owning 25 more stocks. That way, these large guys who are in every IPO will have some 300 stocks by now, 500 stocks in their portfolio. So you know that 2, 3 months plus minus, the old IPO will be sold, whether it made money or lost money. It's not a flaw, it is just the way this world works. For example, if you are a big guy, you will get the research guy coming to you. If you are a small guy, you have to go to a group meeting because the company will not have time also. This is just the way of life. There's nothing so bad otherwise about
But
it.
how are you looking at the valuation part for these companies which are coming out with IPO? Are they, fair valuations coming in, or you are still seeing some high valuation pitches which are
No,
coming in?
that's what I was saying. That if we are in 50 IPOs trying to buy 10 and getting 4 or 5, that means the others got rejected on some reason or the other. And in many cases, it might be just very high valuation for the company size and this thing. I mean, that's why we were not trying for every one of them. And if you tried for every one of them, you'll get a large number because then you will be considered as a friend of the bank, investment bank. So it's not that every stock got rejected on valuation. Sometimes we don't like the sector. Sometimes it's too small. Sometimes it's valuation. Sometimes it's that they are not giving us anyway, whether we like it or not. And we many times buy on day one if the price has not gone up a lot. Because if we liked it, they refused us, we still buy once in a while if we really are serious about it.
Samir, you're great at capturing decadal trends, right? And you understand growth much better than most. I'm trying to understand from a data center and a new age tech standpoint, not platforms, a new age tech in the sense AI and the like. How best do you play that as a team? Sitting out of India, what's the best way to play that where valuations still have comfort?
Very few, you buy all these, which we also have, by the way, because we do like growth. All these Schneider, we don't have, but I'm saying things like that, or Hitachi, or GE Vernova, or you can buy some black box, or all, but those are very small positions because growth is very high, valuation is also quite high. But secondly, it is not clear that when India will get those big data centers, and because right now they are doing training, then there may be something different needed there. Then one day they'll do inference and all that, and we are in sort of in between stage, and by the time some real business comes to these guys and is a sustainable thing, right now it's all orders. Hopefully the orders will uh, mature into business, and that hopefully will 90% of the time. But broadly, these are very, what should I say, limited in terms of options we have. And our weight might be 3-4%. And that also in 3-4 stocks means total 3-4%. So you can call it what you want, but in a portfolio sense, we don't have it today, but we are willing to buy HPCL and 5P stocks on one side, and we are willing to buy a 60P stock on the other side. And all we have to do is balance the weights.
Samir, how should therefore one look at themes that are playing out, and obviously there's a rotation at play at this point in time. What are the sectors, pockets that you're looking at, especially after the Q1 earnings? Anything that's changed for you over the last maybe month and a half, based on commentary you've been listening to, numbers that have come at us?
So broadly, we like NBFCs, number one, in terms of the bigger weights. And we like new age, and we are delighted with the performance of Paytm and Eternal and Ather. all up in the 15-20% range, and more importantly, burning the hearts of everybody who thinks that there is only a certain style of companies that can go up in life. And we also together might have still only 10% in all of them combined, or 12%, but that gives us the sort of a small spread or in performance. Basically, nothing much changes, but when you are buying something which half the world doesn't like, or 60% doesn't like, 30-40% may like these stocks or less, just getting reinforcement that things are on track and things are working in their favor itself is good enough for you to add 0.5% more here or there. You don't need to buy completely new things every quarter. You just need an ongoing reinforcement, and once in a while also change a stock here or there. So my big picture formula is that if you have 50 stocks and every you are willing to change 5 stocks, you can be ready for every phase of the market. You don't need to change 25 stocks, because some large core will be remaining based on your interest and your analysis through different cycles. And some things change because the market changes. I am only different from other fund managers who say this is my 40 stocks and the world can burn or not burn or do very well or do very badly, but this is what I like. We say out of 50 stocks, 40, well, let's say, I'm just giving broad number. Say 40, 45 are what we like, and 5 are we like because today the environment is like ABC. That is the only difference. And for that, we are willing to be short term, trading, whatever you want to call it. It's only these 5, 6 stocks you change and you can be ready for any environment, whatever those 5, 6 are in that period.
How do you look at infra and logistics play? Within infra, I can see Adani Ports being one of the big top holdings for your large and mid cap fund.
All
Given
funds, all funds. Adani Port has been there since 5, 7, 10 years, whatever. And it was there even when they had the issue problem. And recently, as in about, I think 2-3 months ago, we also bought Adani Enterprise. And so that also you can call infra or whatever you want to call it. But we bought it because we like the port, the airport business, which is becoming meaningful. And, broadly, plus minus 2-3 years, it will be a separate company. And even before that, you will be able to see it separately as some SOTP kind of thing. Plus, the new businesses, we are not able to get our hands around how to do, what to do. So let Adanis do it and we can be their silent partner.
and in
And in
logistics,
other infra, I don't know what all you call infra. Yeah, but these are the infra thing. Maybe we also have L&T, which we will buy more when there is more clarity on what is happening in Middle East. We stopped, otherwise we were getting into it and then stopped.
Okay, interesting. Samir, the way I see you playing consumption, one is these new age tech and platform companies. The other way is logistics, right? I see delivery there. I see Shadowfax there. Give us a thesis on those, because the numbers have been very strong on that front.
So I don't own Shadowfax, the Indian guys own it, but delivery we all own because bigger company, and it's the same concept broadly that first of all, big picture, new age is shaking everything, and people are not getting it. I keep saying for these banks, we don't have it in India, but if you've heard of a company called Revolut, it I think as a private company, it has a market cap of $175 billion or something. The owner just bought a yacht for 350 million euros, and it is doing what every bank should have done: just FX changes, FX transfer, quickly seeing it on your app, you're spending this, that, and guy got a market cap of $175 billion. Jamie Dimon, in one of his recent interviews, said he's jealous of Revolut. What I'm saying is we don't have things like that, but we know that we need to buy new things because the old is facing the innovator's dilemma, not knowing whether they should do new things or keep getting their dividend and keep doing their buybacks. When the IT companies did the buyback, it was so shocking. I mean, I don't understand how anybody can even say a word that when the tax rate on your buyback was 39%, somebody was announcing buybacks in India. It is shocking kind of board or whatever, oversight. But anyway, so the point is we like the new, therefore we have to get into things which are feeding the new. if it makes sense or they are gaining market share. And also delivery and all are right up there. They are, you get to play the Misho, the growth in e-commerce, the growth in quick commerce. The shadow fax guy will run the stores for dark stores for Amazon, all these things which you can't buy in some things you can buy in listed, otherwise you buy unlisted big picture growth of these new things.
All right, Samir, always a pleasure having you here, and thank you so much for coming in,
Thank you.
spending time generously and giving us that perspective.